So you're an emerging markets guy. Have we seen any stress on emerging market sovereigns or other sort of ripple effects from the move in oil?
Well, in terms of, you've seen obviously like a very violent sell-off. So you have markets in Saudi Arabia, Russia. These are the sort of very energy-centric markets, and these are down roughly about 15%. Russia's close to it, but that's the implied fall, etc. So yeah, I don't think we've seen the kind of stress globally as yet in terms of, but I think that this is such an interesting juncture we are at, and let me tell you why. The S&P, as you know, is now down nearly 20% from its peak. This is a very important dividing line, because if you look at it historically, and we have done some work on this, whenever the S&P has fallen more than 20%, the probability of a recession rises to more than 60%. And I think that twice in this bull market, we have pulled back from the brink. We went to just about 20%, and we sort of pulled back from that. And the issue here is that if it declines more than 20%, the fear is that you get a vicious cycle then, because then the recession fears rise. And remember, this is the story that I've been sort of pursuing for a while, which is the size of the global financial markets today is 4 times larger than the size of the global economy. So if something happens to that, the feedback loop now works in the reverse. This is not about the economy just reflecting what's in the market. This is about the market now driving what happens in the economy.
So we've been talking about this in recent weeks, that old saying, the stock market is not the economy,
right,
is a fallacy.
Absolutely.
Just given the wealth effect.
Yes, and it's risen over time. As I said, in the 1980s, let's say when we had the 1987 stock market crash, at that point in time, the economy and the stock market were roughly in line. Globally, in fact, the value of global financial markets versus the economy. That was in 87. Now it's 4 times larger. So if you end up getting a massive decline in the market, it has a feedback loop. So I think that's the kind of vicious cycle we have to look out for and try and see whether we can avoid it. But it's very interesting. Even today, we have just about pulled back from the brink of the 20% line.
What about rates markets pricing in a 90% chance of recession?
Yeah, so in terms of the fact that you have different markets doing that, I'm looking as to what could happen that you end up getting a vicious cycle. What's happening here is the fact, and I think this has not been spoken enough, that we had a massive global corporate debt bubble over the last 10 years or so with very low interest rates. So in fact, on many metrics, the US today, the corporate sector is more leveraged than it was even in 2008. The underlying assumption we all had was as long as interest rates stay low, this can go on. But the fault line here is this, that no one has been able to sort of discount for the fact that what if you get a sudden shock to your cash flows? What happens then? And also the fact, something we discussed on an earlier show of yours, 16% of companies in the United States today are defined as zombie companies. These are companies which don't even earn enough cash flow to make their interest payments. So they have to constantly keep coming to the market to be able to refinance. If by any chance the debt markets shut down or freeze and you don't have new issuance, then you end up getting a vicious cycle there too. So that's the fear that we're dealing with about these vicious loops developing both the stock market and the debt market.
But you're not seeing any evidence of that, are you?
No, well, we have seen sort of a big drop down as far as new issuance is concerned over the last few days. So we are seeing some evidence of that, but nothing which is sort of like a
crisis level.
A crisis level.
The fear had been we would see fallen angels when rates spiked, right? And that would cause these triple Bs to fall into trouble. But this came out of a blind spot, the demand shock, the cash flow shock.
Yes, that's right. But we are seeing some of that. We are seeing downgrades now begin to sort of increase. The number of falling angels begin to also increase. So I think that we are poised on a knife's edge here. And the single most important statistic to watch for globally has to now be when does the growth rate in the new cases being reported peak? Because the Chinese market offers a template out here that the moment that number peaked, you ended up getting a sort of restoration of confidence in the Chinese market and also economic activity getting back to some sort of normalcy.
So Deutsche has done some work on this morning. Their point is what matters is when the second derivative of confirmed cases begins to flatten out.
Yeah.
And in their view, I'm quoting, if the U.S. follows the path of China, ex-Hubei, then that could happen within the next week or so.
Yeah. So if that happens, then it means that we're pulled back from the brink. But if this goes on for another 3-4 weeks, then the risk of getting a vicious cycle here is great, because then what you're dealing with is a global corporate debt bubble which meets a once-in-a-century epidemic. And that's a pretty lethal mix. So that's exactly where we stand.
That's pretty scary. Ruchir, the peso is down 6% in Mexico. I mean, just the contagion factor is sort of alive. Where, if anywhere, do you want to be putting your money, moving your money globally? How do you reallocate and rethink the outlook, given that things are changing here so quickly?
Well, I think that you have to look at as to what are going to be the enduring effects of this. Whether we end up crossing this dividing line and end up getting a vicious cycle or not, what are the enduring effects of this? I think that deglobalization is just going to be the really big theme of this decade. So you want to sort of be in economies and in markets which are just not going to be that dependent on the rest of the world. And so in that regard, the cheaper places, and we have a new oil order. I think that is going to last for a while in terms of the fact that the price of oil just keeps, sort of settling at lower and lower levels. And so you want to be more with the oil importing countries. You want to be in countries with large domestic markets and beneficiaries of deglobalization. Those are the enduring effects. What we have to get through over the next 2 or 3 weeks now is hoping that that analysis which you just pointed to is correct, that this follows the China template and it peaks in the next week or so. Because if it goes on for 3-4 weeks, then my fear about the vicious feedback loop developing with the global bond market and also the fact that the stock market crosses the line of 20%, I think you end up getting something which is much more sinister than what's been priced in today.
Ruchir Sharma, thanks for joining us.